Let's bring in Solus Alternative Asset Management's Dan Greenhaus now. Good to see you. To cut or not to cut, that is the question. What's the answer?
Listen, my personal view is, well, listen, as a general view, I think people agree, if not for tariffs, they might have cut at the last meeting and probably would be cutting at the next meeting.
There's no probably. The Fed chair himself said it.
Yeah, well, listen, I don't think he's articulated it as clearly, perhaps, as he did yesterday and today. But I think, absent that tariff debate, they'd probably be, again, if not cutting, on the verge of cutting. My own personal view is they should probably do it anyway, or have done it already. Maybe the last meeting was a bit premature.
You mean preemptively?
I don't want to call it preemptively. I think you mentioned before, like, the economy's doing fine on balance. That's true. Although you are starting to see some weakening in the labor market.
Yeah, jobless claims are elevated.
Jobless claims are going up. Continuing claims are a little more than going up. Mm-hmm. So I think, absent that tariff debate, you could probably say, okay, we're in restrictive territory. Maybe we get 25 or 50 basis points less restrictive. Again, that's what the market's pricing anyway, and that might come in September and December. I think the argument right now is a little more, I don't want to say idiotic, but a little more like a month or two early. Would that make that big of a difference? Probably not, but it would address the issue.
I mean, how do you view the market in the context of what they might or might not do? We're basically at a new high. I mean, we're less than 1% from that.
Yeah, I'm in the camp that generally thinks much like too much market results are ascribed to presidential policy, probably too much market results are ascribed to monetary policy outside the extremes. Obviously, you've got, let's use March 09, where the Fed can buy up everything. That's going to send risk assets higher. And obviously, on the other hand of things, if you start tightening up liquidity, that can have deleterious effects. But for most of that, you can make the same argument for multiples as well. In that middle range where we are, I don't really know that 25 or 50 basis points in one direction or the other really matters.
It's not going to be 25 or 50 basis points. They're going to cut more than 25 or 50 over a stretch of time.
Sure, but
you're talking about an initial move of many that are expected.
Well, I don't know that the economy needs many, and you again articulated just before that it doesn't. I think there is a political component here. I think we obviously Steve just touched on it. I think we have J.D. Vance's tweet from last night we can throw up on the screen. There is a political component here to sort of address some of the political issues that are certainly bubbling around the Federal Reserve in terms of people observing, well, they cut 50 basis points. Here we go. J.D. Vance, I'd love to hear an argument for why Powell cut 50 basis points right before the election, but can't do it now with inflation lower. That is not just a political...
Well, I mean, because there was no Trump trade war or no Trump tariffs before the election.
Yes, there are some answers to that. However, undeniably, inflation is lower. And again, to the extent that we aren't positive how inflation manifests itself, and there's a chart floating around on the interwebs right now from Goldman Sachs, I believe, showing Japanese car export prices, which are down, call it 10 percentage points, meaning, as I've been talking about on the show with you, not all of the tariffs are going to be absorbed by consumers. Some of it's going to be absorbed by the exporting company. So there is, as Jay Powell articulated today, a lot of uncertainty over how much inflation is actually going to materialize here in the United States. And I'm sorry to interrupt. Real quick, let's also remember, tariffs are not inflation, they're a tax. And there's a whole separate conversation around that as well.
Right. So then the tech sector's at a high. Let's bring it full circle to where we started this whole program. What do you make of the move, which has been pretty remarkable, this resurgence in that trade, and whether you should stay with that? I mean, I would mind you, too, that industrials have been doing very well. Financials have been doing very well. This market is all about a lot more than just tech. It's just the biggest names are always in the marquee lights.
Yeah, listen, I've mentioned this a couple of times this year. Mathematically, they're going to do the heavy lifting. They're the biggest companies. But on the other hand, you've got Ralph Lauren at a high. You mentioned the financials. People hear financials, they think the banks. And yes, JP Morgan, yes, Wells Fargo, but also Visa and MasterCard, which are now in the financials. And so you've got a breadth of companies that are doing quite well this year, all of which, in totality, does not suggest there's any worries.
Private equities do